If you feel like you work hard but just can't seem to get ahead, well, you're not alone, nor are you imagining it. According to the OECD, that's the Organization for Economic Cooperation and Development, despite rising employment levels, countries such as Canada are nonetheless facing unprecedented wage stagnation. Joining us now to sort out what's going on in the nation's capital, Armin Yalnizyan, economist and Atkinson Fellow on the Future of Workers. And here in our studio, Sean Mullen, founding executive director of the Brookfield Institute for Innovation and Entrepreneurship, and Craig Alexander, partner and chief economist at Deloitte Canada. And it's great to have Craig, you back here. You here for the first time, Sean. Very nice to have you. And of course, Armin, delighted to welcome you back to our program from the nation's capital. We are going to start with a couple of graphics here just to help paint the picture of what we're talking about tonight. So Sheldon, let's bring the first one up. This is from a previous federal budget. And these lines, as you can see, are rather flat. That's the median wage income of men on the top, looking back over the last 40 plus years, then the median wage income, and then the median wage income of women. And that's a fairly flat line as we go along, suggesting, Craig, weak wage growth, which will be reflected in the next chart. So bring that one up, Sheldon, and we're going to spend a bit of time on this because this looks like a bit of an ink blot survey here or something like that. But take us through it, what we're looking at right now.
So what you're seeing is the relationship between wages and unemployment. And if we went back to the 1970s, 1980s, economists believed that if you had low unemployment, you would have high wage growth, and this would create inflation. The reciprocal was if you had high unemployment, you would have low wage growth and low inflation. And this was actually called the Phillips curve, and it was a trade-off. You could either, if you wanted to have lower unemployment, you had to accept a higher rate of inflation. And this relationship seems to have broken down in recent decades. And this chart is actually for Canada. You could actually put the same chart up for the United States. You could put it up for the UK, and you would see the exact same thing. And even if you take off inflation and you say, okay, so what's happening, for any given level of unemployment, what wage rate are you getting? And the answer is you're getting a lot lower wage growth than you ever had in the past.
And just to help explain what those, we see the darker dots in the middle, then there's lighter dots in the periphery, and you've got those perforated lines basically going, down. What does that all reflect?
So the different colors and lines show you what's been happening over time. So, at the top of the slide, you can see that in this from 1966 to 1997, for any given unemployment rate, looking across the bottom, you had higher wage growth. And then you can see in the late 90s, early 2000s, what you can see is that has come down. And then again, for 2013 to 2018, the blue dots, if you look at an unemployment rate there around sort of 6 to 7%, you're getting below 5% wage growth. And what this is telling you is that as the labor market tightens, you aren't seeing the sort of wage growth that we had in the past. And what's important is you could strip off the cost of living and you'd still get the same story. So this doesn't reflect the fact that we had high inflation in the past that pushed up wages. In point of fact, what you're getting is low unemployment with low wage growth.
Well, I think we actually have, at the risk of overdoing it with the charts, I think we do have one here, wage growth before and after inflation. Sheldon, you want to grab that one here? And let's put that one up. You can see, we go back to 1993 on this one, and then as you go across, there's that dip below the line, that of course being the aftermath of the Great Recession. And in the post-financial crisis period, we do, Craig, seem to see wages, bouncing back up again. But then go to the end of that line, and we see them coming down again.
So what we saw in 2015 and 2016 reflects the commodity shock, where oil prices tumbled. Alberta went into a very deep recession. So I think when you look at this chart, what you can see is some of the larger wage gains that were happening pre-2015 reflected very high commodity prices. People might remember, the oil patch was absolutely booming, unemployment was low, jobs were, scarce, and this was bidding up wages in that sector. And then when the oil prices tumbled, you had a big drop in wage growth. Then in 2017, the tide turned and wages bounced back up. And in fact, we got up to wage growth of above 3%. And it looked like, as the unemployment rate more recently has come down to a 40-year low, it looked like we were starting to finally see some wage growth. But in the last 3 months, it lost momentum again. And now wage growth, in the last monthly data point, wage growth for permanent workers was 2.6%. Well, the rate of inflation was 2.8. And what really matters is the difference. So if the cost of living is going up the same pace as your wages are going up, you're not actually making any headway.
So, with all of that great background in place, thank you very much. Let's go to Armin in the nation's capital and start to try to ask the question, why? Why are wages not going up? Armin, start us off.
Well, I think there's three major factors. One of them is not the unemployment rate might not be your most excellent measure. It used to be in the past, but now there is slack in the market, even with low unemployment rates, because you've got more people that have dropped out of the labor force that could jump back in. I'm talking about older workers. We've got a growing cohort of older workers that might be retired but could drop back in, part-time volunteer consulting. You've got a lot more people that are engaging in post-secondary education, so they're officially out of the labor market, but they can drop back in too. And you've got a lot more people that are in neither education or training, and they're out of the labor force, a higher proportion in Canada than elsewhere, particularly amongst men. So there's still slack in the labor market, even though the unemployment rate is down at 4-decade lows. Secondly, you've got technological change, which is unbundling jobs into tasks. So you've got more and more types of work that used to be done. Yes, I'm employed, but I've got a shorter term contract than I did in the past. And lastly, where we do have labor shortages, we have more likelihood to use temporary foreign workers. So you've got more competition for more types of jobs, which will also tend to depress wages. These three things have really accelerated. All three of them have accelerated in the last 2 decades. And I had to go back to my history books and remember when it was that Alan Greenspan pointed to this very same thing. And it was at the end of 1996 and the beginning of 1997 when he said he wasn't going to raise raise interest rates. Yeah. Because even though unemployment was at very low levels, there was no wage pressure. And there was no wage pressure, he said, because of job insecurity. And when you don't have security, you can't ask for more. And that's been a story that's been going on for the last 2 decades.
Gotcha. Sean, what would you add to that in terms of why wages are stubbornly not going up?
Yeah, so I think this is one of those mysteries where there's probably multiple causes. So I would agree with Armin on all those being part of the answer. I would add to it, there's been widespread low productivity growth, which again is, how much are we getting, economic activity are we getting from our workers? And that's not necessarily the workers' fault. That means companies and others have to invest in productivity and training. But both in Canada and in the United States and in other Western countries, we've had very low productivity growth for the past, since the financial crisis. If labor productivity is not increasing, it's harder for companies to translate any gains onto workers. It's harder for workers to have bargaining power to increase wages.
Let me just stop you there, because I do want to follow up on that one. Craig, we've been hearing about the low productivity of the Canadian worker for decades. So that's not new. Why would that be particularly an issue now as it relates to the stubbornness of wages not going up?
So the weak labor productivity has been a conundrum for decades, as you say, but it's actually been getting steadily worse. Like if we actually look at labor productivity, it's been steadily declining. And when you look at wage growth, one of the questions you get is, well, if the economy's growing and additional income is getting created, what's the split between how much is going to workers and how much is going to the interests of capital? In the United States, it's very clear that capital has been getting a bigger share of the wage growth, that workers have not had the labor productivity reflected in wages. That isn't the case in Canada. In the 2000s, what's really happened is the labor share of income has been relatively steady. The problem is that labor productivity has been very weak. So if you have a worker that can build, one computer app in a month, and the person becomes more skilled and faster at the task, and the next month can actually produce 2, well, you can pay that worker more because that worker is actually generating more revenues for the company. The question is, is it equitable? Does the company share the income gains? And in Canada, the data would suggest that yes, if labor productivity was stronger, workers would actually benefit by more. Now, I do think that there's another dimension to this, and that is that high-skilled labor is in demand. Low-skilled jobs are still present, but a lot of the technological change has reduced demand for middle-skill workers, traditional sort of manufacturing-type job workers that have now been replaced by things like robotics. And so as a consequence, we have too many middle-skill workers, and on a net basis, their jobs, the number of those jobs has actually declined over time. And high-skilled jobs, jobs in high-tech services like the IT sector have been growing, and those workers in those sectors that are in demand, they can actually negotiate higher wages. But there's a lot of workers out there that don't have the bargaining power to negotiate higher wages.
We're going to follow up on that automation and robotics angle a little further on. Okay, I interrupted you. Was there anything you wanted to add to besides the bad productivity?
The only thing I would say on productivity is that Canada's been lagging for decades, but there's been a slowdown in the United States as well since the financial recession. And this wage stagnation is not specific to just Canada, so it's an interesting phenomenon that it's popping up there as well.
Sean, let me get you to follow up on another angle that I've read about this, which is that wages have been stagnant in part because some of the superstar companies out there that we are told we ought to be admiring for all of the innovation they've brought to the marketplace are actually dampening any kind of wage increases. Google, Amazon, these kinds of companies. Paint that picture for us.
Yeah, so there's a theory, it's called the rise of the superstar firm. And there's some economists who have been working on this, but an economist out of MIT called David Otter has done quite a bit of work on this. And the theory is basically we, not just in tech, but tech is probably the most visible example, but we're moving towards a greater concentration of very large firms and industries. They tend to dominate the economic activity, and they kind of set the bar. And so, well, if you're working for those firms, you might actually do very well. Anyone else who tries to compete in that industry, other firms, they don't have the advantages, and they're not able to compete, and certainly not able to translate wage increases onto their workers. So think of everyone who's in the grocery business now having to compete with Amazon. Amazon's in there; they're incredibly productive. They're keeping wages down, or they're paying their workers good salaries, potentially. But anyone who's competing with them may think back and say, well, I can't pay my workers more right now. I got to make sure I'm reacting to this threat.
Well, let me put that to Armin, because that's one way to approach it. The other way to approach it would be, if I'm going to compete with these giants, I need better people, and to attract better people, I got to offer higher wages, and that's the way I can get more competitive. Why doesn't it work that way?
That's an excellent question, and I think it's because profit margins have been shrinking in the post-recession environment, and things are getting pretty cutthroat. So we've seen this incredible wave of corporate consolidation. In fact, I tweeted a reference to a series of papers today on my Twitter account that talks about the cartelization of the global economy, where large players are eating other players up and increasing their bargaining power. So, the mention was made of Amazon paying some of their workers good wages, but in fact, we're seeing that Amazon has the capacity of keeping wages down, as did Walmart. It's a hugely successful company because of its scale, but doesn't pay its workers particularly well. And as these companies take up more and more market share, they start driving the norm of payment, both in wages and benefits, as well as hours of work and access to stability. We've got Amazon also driving some platform economies. I did mention, and I know we're going to be talking about technology later, but one of the big things about productivity that is being driven by technological change is a lot of technological change now permits us to unbundle jobs and turn them into tasks, which you can open up to competitive bidding. And all these trends in technology tend to drive down marginal costs. Well, if you're driving down marginal costs, you're also going to be driving down how much you can pay people. The flip side of a cheap price is a cheap wage for someone somewhere. The flip side of something free is somebody's not making money doing it. So I think there's that phenomenon too, which, we say, well, we should be seeing more in productivity, but productivity growth is not usually measured in terms of consumer welfare. It's usually measured in terms terms of the ability to more efficiently produce revenues and to increase scale. But now we can increase scale without actually adding very much marginal cost, sometimes zero marginal cost if it's a digital product.
Craig, let me put to you one of the pieces of conventional wisdom which we frequently hear, which is a lot of this is going to resolve itself once all the boomers decide to retire, and then there becomes a need for more employment, and I guess his generation will swoop right in and pick up these jobs, and the demand for them will be such that wages will increase. How do you like the way that sounds?
Well, I do think the demographics is having a very profound impact on the labor market. And the baby boomers throughout their entire life cycle have changed the economy, and their exit is going to have a big impact as well. I think a lot of the long-term projections show that there's going to be labor shortages in certain occupations because as those baby boomers exit, for example, in the trades, because families today want kids to go off to university and get skills for a white-collar job. In point of fact, where we actually might see some of the biggest shortages could be in trades, if the work cannot be replaced by a machine, right? So as the baby boomers leave, I do think that could create some labor shortages. And I don't think the laws of economics have been broken. I think when we look at what happened with Alberta during their boom, when the unemployment rate in Calgary got below 3%, you reached a point where firms actually did have to pay more wages. So the point is that the unemployment rate, though, can go a lot lower than it currently is without creating the wage pressures. And in fact, this is precisely why the Bank of Canada has interest rates still very low. Like, there has been a policy response to the low wage growth, and that policy response has been to keep interest rates low to try and promote growth and create jobs. The point is that there is still, as Armin mentioned, even though the unemployment rate is low, there is still some slack out there in the labor market, and the baby boomers are contributing to that.
What does that mean? There's slack in the labor market refers to what?
So when the unemployment rate might be at a 40-year low, but the shortages of labor, might be concentrated only in certain skills. There might still be a significant number of workers that could join the labor market. So a good example of this is the rate of employment, for example. We always talk about the unemployment rate. This is what percentage of workers have jobs. And what you find is the employment rate today, even though the unemployment rate's at a 40-year low, the employment rate's 2 percentage points below where it was before the recession. So in other words, there still might be some workers out there that we could employ. In fact, you can see pools of them. So for example, Canada is not doing a very effective job of integrating newcomers, immigrants, into the economy. Newcomers get paid significantly less for the same amount of skills, for education, for experience in the Canadian market. In point of fact, we're undervaluing the immigrants. And I actually think that's contributing to some of the slow wage growth because more of our labor market growth is coming from immigration. We also have a demographic effect. You have baby boomers who have more experience, that get paid higher wages, leaving the labor market, and they're getting replaced by young workers that don't have experience and get paid lower wages. And this always happens, but at this point in time, the baby boomers are such a large share of the labor market, this demographic effect could actually be depressing wages.
But let me pick up on the particularity of the point you made with regard to the jobs. Armin, I'll go back to you on this. There are a lot of 50, 60, 70-year-old plumbers and framers and bricklayers and so on who are going to retire over the next number of years. And, this guy's generation, they all want the nice white-collar jobs, as Craig suggested, which suggests that if you do go into that line of work, you're going to be able to write your own ticket for whatever you're going to get paid. Is that, Armin, a potential boon in the future for those jobs and for potential rises in salary?
That's an excellent question, and normally I'd say yes, because normally we've been operating in basically a closed economy when it comes to labor. But increasingly, there's going to be two barbells that are going to lift the economy in the next decade. One is going to be the retiring, the aging boomers are going to create more demand for the caring professions. Everything from personal care workers to highly specialized doctors and everything in between. And as the dependency ratio rises, that is the working age population and the number of people they have to support that are both too old to work and too young to work, then we're going to need more child care workers too. So that's going to be one of the real thrusts of the next economy. And there's plenty of Canadians who could do the job, but how many of them will do the job? How many of them will we be bringing in from offshore, both as temporary workers and permanent immigrants, to replace the people to actually add? And what you raised, well, we've got the biggest wave of infrastructure investment on the books in half a century. So we know that the demand for those skilled trades is going to continue to grow. But there's nothing to prevent the big proponents of these contracts to bring in workers from offshore to do these jobs. So it's not necessary that they will be hiring third-year apprentices when they can bring in fully ticketed journeymen for a lower price point. So we really have to make a public policy decision on if we're going to have these fairly widespread labor shortages and very specific skill shortages. Are we going to be actually boosting the potential skill capacity of all Canadians, including those people that are underutilized right now, or are we going to be importing the solution? And there, I don't think we have a particularly coherent set of policies in place right now. Some policies work counter other policies at the moment. I think it's a question that we're really going to have to grapple with, and very shortly.
Sean, what's your take on all of that?
I mean, I think Armin is on the point, and it goes back to kind of what Craig was saying about this gap between highly skilled workers and lower skilled workers, and I think it's a really instructive point for explaining what's going on. Lower skilled workers increasingly becoming commoditized, increasingly becoming at risk, hard to ask for wage gains. Higher skilled workers, both in tech economy, but a skilled trade is a high skilled worker. And you're seeing shortages, but it's not easy to transition between those types of roles. And that's, I think, why you're seeing this mismatch between an economy-wide wage levels not increasing very high, but at certain areas you're seeing gaps.
Let's do a bit of a comparison, Craig, between the private and the public sectors. For the basic jobs, so we're talking less than six figures, those kinds of jobs, who gets paid better?
I would say that the public sector is a sector that has a higher representation of unionization. And I think one of the reasons why in the private sector we've actually seen weaker wage growth has been sort of the decline of unionization. So in the public sector, you have an awful lot of unionized representation. I think it has supported wages in those sectors. And then the other thing is that we tend to focus on wages, but what really matters is wages plus benefits. And often what you can see in the public sector is benefits that the private sector can't afford. So, I think that
Can't afford or chooses not to afford?
Well, again, it comes down to competitiveness, right? So the private sector is experiencing enormous competitive pressures. Even in good economic times, like outside of recessions, when in the past you might have seen more wage growth, what's actually happening is businesses are facing intense competition. It could be coming from the sort of new giant firms. It could just be the fact that we now have a globalized economy and you're competing with the entire world.
I do hear that, but I remember the late Jim Flaherty saying, you corporations are sitting on $2 trillion of dead money. So it's not a question of them not having the money, it's a question of them choosing not to spend it that way.
We could have a big debate about this.
Okay, all right, that's another show.
I think there actually is a rational reason why businesses in Canada post-financial crisis became more conservative with how they managed their balance sheet. And so,
but that is a different show.
Yes, they're holding on to more cash, but that's a different show.
Okay, well, let me go to Armin on this. Again, Armin, this is all sort of old-fashioned conventional wisdom, but you tell me what practical application it has today. I think there used to be an argument that the public sector tended to pay, for example, secretaries or assistants or that kind of thing, better than the private sector, in the hopes that that would set a new benchmark, and then the private sector would therefore follow, and wages, generally speaking, would go up. Does that phenomenon still happen in our society?
Oh, that is such a mixed up pot of issues. Okay, so the difference between the public and the private sector is you get more, comparing the public sector to the private sector, you get longer job tenure in the public sector because there's a lot more churn in the private sector, a lot more part-time jobs, a lot fewer full-time, full-year jobs. So that's going to drive down the wages in the private sector. Another part that drives up wages in the public sector is that you've got more engineers, you've got more statisticians, you've got more lawyers, you've got more people that have higher level, and more doctors, don't forget, because the public sector includes doctors, which are amongst the highest paid groups. So just the occupational mix and the industrial mix of work that gets done in the public sector tends to favor people that have more investment in their human capital. In fact, in the jobs where they're directly competing, high-skilled people, the public sector tends to pay less than the private sector for the high skill. For the low skill, you called it the typical job. I don't know which typical jobs, but if you're talking about secretaries and clerical workers, we've got this thing called pay equity. The laws on the books mean that women can't be paid less than men doing work of equal value. And so pay equity legislation has, in fact, created better paying jobs, marginally better paying, but better paying jobs, and as Craig said, benefits for these kind of medium skilled or lower skilled workers because of the law. And it had been hoped that having the government as a model employer, that there would be more copycats in the private sector, but there has been more competition for sure in the private sector. And secondly, it's very difficult for a government to ignore the laws that it actually passes on its own books. So it's in a different box also. Those are the factors that are, and also public sector workers tend to be older than private sector workers on average because of this tenure, because of the skill set. And so you're not really looking at comparable groups of workers. When you look at comparable occupations, you will see differences that lower skilled workers tend to get paid and compensated in total better than in the private sector because there is so much more turnover, and higher skilled workers tend to get paid less well than the private sector. So it really does depend on who you're looking at, who's getting paid better. But can I just say, somebody raised the point about lower unionization rates. Canada is an exception again in unionization rates. About 3/4 of the public sector is organized, which is much higher than in many jurisdictions. But we haven't been, it's been fascinating. Since the recession, we haven't really been losing that much ground in the private sector. Only about 13-14% of the private sector is unionized, but it has not continued to drop. So Canadian exceptionalism is we're not losing ground in terms of unionization. And perhaps that's one of the reasons why bargaining power has not deteriorated so dramatically. But bargaining power is really the nugget of the story here, is that companies have got more bargaining power and workers have got less bargaining power over the last few years, and it's showing up in how wages grow.
Okay, we got 5 minutes left, and I want to tackle two more things here. I want a quick comment from you, Sean, on the attempt, obviously, in the view of the previous Liberal government of Ontario, the marketplace was not doing an adequate job to lift wages, and so they did it. They raised the minimum wage significantly, 32% in 1 year. In terms of a mechanism for getting all wages to go up, your view on whether that huge increase in the minimum wage did it?
Yeah, I think it's one of the important tools that are out there. And it wasn't just here in Ontario. There's examples in Seattle and other states in the US. A lot of debate amongst economists, data is still coming in, but I think the top line examination of this is that the kind of negative implications of higher minimum wage were overstated, at least to date, and certainly is having an impact on workers that are right at or would have been below that new rate.
Well, let me go, Craig, to you on the next level, which is if somebody was making $10 an hour and then suddenly the minimum wage is 15, well, I guess it's 14, and they suddenly get 14, the person who was then making 13, the argument goes, is now going to want 20. Do we know whether or not that minimum wage therefore percolated through the entire economy and got the next rung of people paid more as well?
So I think the data is still anecdotal, but if you ask companies, there's certainly companies that are getting pressure from workers, because every worker knows, that receives an hourly wage, knows how much over the minimum they were getting. And so they could easily do the calculation and say, well, now, I was making $2 above minimum. I want $2 more above minimum now. I do think part of the response that we're seeing in the private sector, though, is to substitute, where possible, capital for some of those minimum wage jobs. So when you go to the grocery store, when you go to the retail outlets, you're going to see a lot more self-checkout counters, because this is part of the way that they're responding. Now, some of it's getting passed along to consumers. You can actually see it in the data that some prices have come up to offset the impact, at least part of it, of the minimum wage. But I also think businesses are adjusting their business models.
Let me jump in here because I want to get your take in the last couple of minutes that we've still got satellite line to Ottawa on what impact that is going to have on depressing wages or not going forward.
Steve, we don't know. We don't know whether automation is going to create more jobs or destroy more jobs. It's one of those unknowables a priori. But one of the interesting things about that social experiment of raising the minimum wage as dramatically as it was, and good Lord knows that was a social experiment. If you couldn't kill jobs with that move, you can't kill jobs by raising the minimum wage. And in fact, what we saw was so far not much of an employment effect, some benefits effects. So in other words, some people, not much loss of jobs or even hours of work, but some compensating other benefits that were cut in some workplaces. But on the other hand, a lot of places that pay the minimum wage also are places that people that earn the minimum wage go shopping, so they got more business. So it seemed to be kind of boost the economy from the bottom up type of measure. So do you always need to automate because your prices, because your wage rates are going up? It depends on what your bottom line is in terms of revenues and profits, and whether that creates enough of an incentive for you to automate. Don't forget, automation requires huge, deep pockets for capital. And a lot of these companies are using their capital, that dead money that they were sitting on, to buy other companies, to buy market share. That's how they are using the money to protect themselves in an era of accelerated competition, rather than investing in self-driving fleets,
Okay,
automated
Armin, I'm
fleets.
jumping in here because if I don't, I won't have enough time to say thank you because we're going to lose our line to Ottawa. So thank you, Armin
sorry about that.
Yanlesian, for being there for us, the Atkinson Fellow on the Future of Workers from the nation's capital. Until next time, Armin, okay?
Radio.
Thanks so much. All right, we've still got about a minute to go here before our time is up. So, Sean, why don't you wrap it all up for us in terms of automation? Armin says we don't know what impact that's going to have on whether wages are going to go up or down in the future. You got anything to add on that?
Yeah, I think she's right at the economy-wide level. I think what we do know from previous experiences is areas of the economy where there'll be investment in automation that will create and effectively enhance jobs, so to make someone more productive, will ultimately result in better wages for that individual, for that worker, for that occupation. But on the flip side, where it's threatening jobs, like retail cashiers, for example, that's going to be just one more factor in holding down or even depressing wages. And so you have to look at how the technology is going to be applied and how it'll affect the individual occupations to kind of answer that question.
And that is our time. That's Sean Mullen, the Brookfield Institute for Innovation and Entrepreneurship. We thank him. We thank Craig Alexander, the chief economist from Deloitte Canada. Good to have both of you here on TVO tonight.
Thanks.
The Agenda with Steve Bacon is brought to you by the Chartered Professional Accountants of Ontario, helping businesses stay on the right side of change with strategic thinking, insightful decisions, and business leadership. Are you on the right side of change? Ask an Ontario CPA.